7 countries are now flashing the exact same financial pattern that has appeared before every major sovereign collapse of the last 200 years. The same debt ratios, the same currency deterioration, the same political choices, and right now IMF economists are monitoring all 7 in real time. But here is the part mainstream financial media is not telling you. 3 of those 7 countries are not in the developing world. One sits inside Europe's sphere of influence. One is the 3rd largest economy on earth. Then one of them, the one professional economists are most hesitant to name publicly, is the country whose currency you are almost certainly using to store your savings right now. Today we are going to run the full countdown country by country, debt ratio by debt ratio, warning sign by warning sign. And by the end of this video, you will understand with complete clarity why the next global financial crisis does not begin where the media is currently looking. Let's begin. Before we get into the countdown, I need to establish something critical because most people watching a video like this assume it is about foreign countries, distant economies, places that have nothing to do with their daily lives. That assumption is exactly wrong. And understanding why it is wrong may be the single most important financial insight you take away from this video. When a sovereign nation enters a debt crisis, when its government can no longer service the interest on what it owes, the first casualty is always its currency. That currency does not decline slowly. It breaks rapidly in ways that can compress years of savings destruction into a matter of weeks, sometimes even days. In Zimbabwe in 2008, the government printed a $100 trillion note. That note could not buy a loaf of bread. In Venezuela between 2016 and 2019, annual inflation exceeded 1 million%. Workers who were paid on Monday discovered that by Friday, their salary had already lost 30% of its purchasing power. In Weimar Germany in 1923, workers demanded to be paid twice a day because by the afternoon, the money they had received in the morning had already lost meaningful real value. These are not ancient oddities. They are recent events separated from us not by centuries but by years. And the mechanism that creates them is the same every single time. Excessive debt accumulation, currency debasement, loss of creditor confidence, and political leadership that answers each crisis by building the conditions for the next larger crisis. Ray Dalio spent 40 years studying that mechanism across hundreds of economies and 800 years of historical data. The conclusion of that work is captured in a framework he calls the long-term debt cycle. And his conclusion is not vague, it is precise. Every country that follows the same sequence of financial decisions reaches the same destination. The timing changes, the sequence does not, and neither does the ending. Today, using Dalio's framework, supported by Kenneth Rogoff's sovereign debt research across 66 countries and 8 centuries, we are going to run 7 nations through that sequence. We are going to identify exactly where each one stands in the cycle, and we are going to answer the question this video asks: which one reaches the end point first? Before the countdown starts, you need to understand 3 numbers, because these 3 numbers define the warning system that Rogoff and Reinhardt identified in their landmark research. And every country on this list will be measured against all 3. Number 1, 90%. That is the debt to GDP ratio at which sovereign risk stops being manageable and starts becoming structural. Rogoff and Reinhardt studied 66 countries across 8 centuries and found that once a nation's total debt rises above 90% of its annual economic output, median growth rates fall by roughly 1% per year. And the probability of a debt restructuring event, meaning a default or a forced renegotiation, rises by 400%. A country does not collapse the moment it hits 90%. But from that point on, the mathematical runway shortens dramatically, and every future shock hits a system with far less ability to absorb it. Number 2, 3 months. That is the minimum level of foreign exchange reserve coverage that separates a nation under financial stress from a nation in full financial crisis. Foreign exchange reserves are a country's emergency fund, the dollars, euros, gold, and internationally recognized assets it holds to pay for imports and defend its currency. When those reserves fall below 3 months of import coverage, the country enters what the IMF formally classifies as reserve distress. It can no longer defend its currency from speculative attack. It can no longer guarantee that it can cover its import bills, and it begins making the choice no government ever wants to admit publicly, whether to service debt or import food. Number three, the moment political leadership abandons monetary orthodoxy. This is the tipping point Dalio identifies as the irreversible signal. Every modern collapse, Argentina in 2001, Turkey in 2021, Venezuela throughout the 2010s, Sri Lanka in 2022, is preceded by a government that, under the double pressure of creditors demanding austerity and citizens demanding relief, begins printing money to solve a debt problem. In the short term, that decision feels rational. In the medium term, it is catastrophic. You cannot print your way out of a debt crisis. The attempt turns a debt crisis, which is still recoverable, into a currency crisis, which is much harder to reverse and far more destructive for ordinary people. When all three signals appear at once, Rogoff calls it the triple coincidence. In 30 years of research across dozens of countries, every nation that reached the triple coincidence went on to experience a formal default, a debt restructuring, or a currency collapse within 18 months, without exception. That is the framework. Now the countdown. Country number 7, Bangladesh. Bangladesh surprises a lot of people on this list because it has been one of the genuine economic success stories of the early 21st century. Between 2000 and 2020, Bangladesh lifted 25 million people out of extreme poverty. Its ready-made garment industry became the second largest in the world, supplying H&M, Zara, Gap, and nearly every major Western fashion brand. GDP expanded at 6 to 7% a year for almost 2 decades. The World Bank described it as a development model. Then 3 simultaneous shocks hit, and the model's structural weakness was exposed. The pandemic disrupted the global garment supply chain and cut Bangladesh's export revenues by 17% in a single year, the largest external revenue shock the economy had ever taken. Then the global energy crisis of 2022 pushed Bangladesh's fuel import bill from around $6 billion to more than $12 billion in just 12 months, a 100% increase in the cost of keeping the power grid and factories running. And then the U.S. Federal Reserve launched the most aggressive interest rate hiking cycle in 40 years, sharply strengthening the dollar and increasing the real cost of every dollar-denominated debt payment Bangladesh owed to international creditors. The result of all 3 shocks landing at once was a reserve crisis that moved with stunning speed. Bangladesh's foreign exchange reserves dropped from $46 billion to below $21 billion in 18 months, a 55% depletion of the National Emergency Fund in just a year and a half. The government began rationing electricity. Factories, the same factories supplying Western fashion brands, started shutting down for 10 to 12 hours a day because the government could no longer afford the fuel needed to keep the national grid fully operational. Bangladesh ranks number 7 on this countdown because its debt-to-GDP ratio of 39% is still well below Rogoff's 90% threshold. The debt burden itself is not yet the crisis, but the speed and direction of reserve depletion is the warning sign that puts Bangladesh on this list. In Dalio's framework, direction of travel is everything. A country with low debt and rapidly disappearing reserves can be more dangerous than a country with high debt and stable reserves because the low-debt country can still borrow, and it will keep borrowing until the market finally says no. Country number 6, Egypt. Egypt receives remarkably little attention in Western financial media considering how systemically important it is. That is a serious analytical failure. Egypt controls the Suez Canal, one of only 2 maritime choke points through which global trade cannot easily be rerouted. It imports 80% of its wheat from international markets, making it uniquely vulnerable to global commodity shocks. It has a population of 107 million people, the largest in the Arab world, growing at 2% a year and demanding food, energy, and jobs. that the state is structurally incapable of providing. Egypt's debt to GDP ratio reached 95% in 2024, above Rogoff's threshold. Its foreign exchange reserves have been under distress since 2022, when Russia's invasion of Ukraine, Egypt's main wheat supplier, which provided roughly 80% of its wheat imports, both cut supply and pushed global wheat prices up by 60%. Egypt was forced to spend dollars. It did not have to import food it could not grow. The IMF has stepped into Egypt 3 times since 2016. Across those interventions, Egypt has received more than $20 billion in emergency IMF financing. Every loan came with conditions, subsidy cuts, currency devaluations, fiscal consolidation. Every round of austerity generated intense political pressure in a country where food already consumes 40 to 50% of household income for the poorest half of the population. Every currency devaluation made the next import bill more expensive in local terms, which required the next round of borrowing, which required the next round of austerity. The Egyptian pound has lost 60% of its value against the dollar since 2022. Bread subsidies, which the government has maintained since President Nasser established them in the 1950s as part of a social contract with the population, are now consuming a budget that can no longer mathematically sustain them. The choice between paying international creditors and feeding the population is no longer theoretical. It is the actual budget decision Egyptian finance ministers are making right now. Egypt has 2 of the 3 warning signs active: debt above 90%, reserves under structural pressure. The third, political abandonment of monetary orthodoxy, is under active strain. It is the only signal keeping Egypt from the very top of this countdown, and that signal is weakening. Country number 5, Pakistan. Pakistan is where the triple coincidence starts becoming visible to the naked eye. Debt to GDP 87%, approaching the threshold with no credible path to reduction. Foreign exchange reserves in January 2023, $3.7 billion. That is less than 3 weeks of import coverage. Not 3 months, 3 weeks. Pakistan was within days, not weeks, days of a formal sovereign default when the IMF intervened with a $3 billion emergency facility that delivered just enough liquidity to prevent immediate collapse. Pakistan has gone to the IMF 23 times since 1958. That number matters enormously because it tells you something exact about the nature of the problem. IMF programs do not solve structural vulnerabilities. They postpone them. They buy time in exchange for policy conditions, usually fiscal consolidation, subsidy cuts, and monetary tightening, all of which are politically painful and are often reversed by the next government that wins office promising to undo them. The cycle repeats. The debt compounds. The structural weakness remains. Pakistan's energy crisis is the most severe in Asia outside of active war zones. The country generates roughly 40% of its electricity from imported fuel. When global energy prices surged after the Ukraine war, Pakistan's energy import bill doubled in a single fiscal year. The government faced an impossible political choice: pass the higher cost to consumers through electricity prices or subsidize the difference with borrowed money. It chose the subsidy. The subsidy was financed with debt. The debt increased interest costs. And interest costs now consume more than 50% of total federal revenue. 50% of federal revenue is being consumed by interest alone. That is not some developing world statistic global markets can dismiss as irrelevant. That is Dalio's stage 5. That is the mathematical trap from which there is no organic exit. Every rupee used to service existing debt is a rupee that cannot be invested in the energy infrastructure that would reduce import dependence and shrink the future import bill. The trap does not ease. It tightens with every payment cycle. Country number 4, Turkey. Turkey is the case study that should disturb every investor who believes monetary credibility, once built, is hard to destroy. because Turkey proved the opposite. It proved that a G20 economy, a NATO member, a country with sophisticated financial institutions and a functioning central bank can destroy decades of monetary credibility in under 2 years through a single sustained act of political interference in monetary policy. Between 2021 and 2023, Turkish inflation reached 85%, the highest inflation rate in any G20 economy since Argentina's crisis in the early 2000s. The Turkish lira lost 80% of its value against the dollar in 3 years. Families who had saved in lira watched those savings lose more than half of their real purchasing power in a span of time most people would normally mistake for a standard economic cycle. The cause was not external. It was not war or a supply shock or a pandemic. It was a deliberate policy decision by President Erdogan, who held the unorthodox view that high interest rates cause inflation rather than reduce it. Every credentialed economist disagreed. Every central bank model disagreed, and the market disagreed by selling the lira consistently and aggressively. Erdogan kept cutting rates even as inflation rose for 20 straight months. Turkey matters to this countdown not because of where it is headed now. A new central bank governor appointed in 2023 raised rates aggressively to 40%, and inflation has since fallen from 85% to roughly 30%. Still catastrophic, but declining. Turkey matters because it proves the mechanism. It shows in real time in a modern economy with all the institutional structure of a developed country exactly how fast monetary credibility can collapse when political leadership overrides institutional independence. And it shows how painfully long recovery takes. 2 years of corrective policy and inflation is still at 30%. Purchasing power has not been restored. Trust in the currency is not returned. That mechanism, political override of monetary independence, is the exact warning sign to monitor in every other country on this list. Country number 3, Argentina. Argentina has defaulted on its sovereign debt 9 times, 9 more than any other country in the modern era. And the reason it sits at number 3 rather than number 1 is that Argentina has paradoxically become so familiar with crisis that it has built institutional muscle memory for surviving it. At enormous human cost, but surviving it, the 2001 default remains the most instructive case. Argentina had maintained a 1-to-1 peso to dollar peg since 1991. For a decade, the peg appeared to work. It controlled inflation, attracted foreign investment, and stabilized an economy that had been destroyed by hyperinflation in the 1980s. But a fixed exchange rate requires permanent fiscal discipline. Argentina ran persistent deficits. The IMF extended loans tied to austerity. The austerity sparked social unrest. The unrest produced political paralysis. The paralysis prevented the fiscal reforms the IMF required to continue lending. And in December 2001, Argentina defaulted on $93 billion of sovereign debt, the largest sovereign default in history at that time. What followed is the template for what collapse really looks like for ordinary people. Savings accounts were frozen because the government could not allow a bank run. When those accounts were finally unfrozen, they were converted from dollars into pesos at 1.4 pesos per dollar, the official rate. Within months, the black market rate had moved to 3.5 pesos per dollar. Anyone who had saved dollars inside an Argentine bank lost 70% of the real value of those savings. Not in a market crash they could prepare for, in a government decree issued over a weekend. Today, Argentina's new president, MLE, is running the most radical fiscal experiment in Latin American history, eliminating ministries, cutting public spending by 30%, and pursuing full dollarization of the economy. The experiment has produced a primary fiscal surplus for the first time in over a decade, but inflation is still above 100% annually, and poverty is rising as the spending cuts take hold. The experiment may work, but the historical record of recovery from Argentine default suggests the timeline is measured in decades, not years. Country number 2, Japan. Japan is the most important country on this list that the financial media almost never talks about. And understanding why Japan matters requires you to suspend almost every intuition you have about what dangerous debt looks like. Japan's debt to GDP ratio is 263%. That is not a typo. 263% of annual GDP, the highest sovereign debt ratio of any developed economy in recorded history by a wide margin. Under Rogoff's framework, under almost any conventional economic framework, Japan should have faced a debt crisis 20 years ago. And it did not. And the reason it did not is one of the most important insights in modern sovereign debt economics. Japan owes almost all of its debt to itself. More than 90% of Japanese government bonds are held by Japanese institutions, the Bank of Japan through quantitative easing, Japanese pension funds, Japanese insurance companies, Japanese regional banks. There is no external creditor demanding repayment in foreign currency. There is no foreign exchange crisis risk driven by an external sell-off. The Japanese government owes money to the Japanese people, and the Japanese people, through their institutions, continue to absorb that debt at near zero interest rates because the alternative, pulling out of the system, would be self-destructive. This closed loop is what has kept Japan functioning at 263%, but in 2022, that loop showed its first serious crack. Global inflation, driven by energy costs and supply chain disruptions, reached Japan for the first time in 30 years. The Bank of Japan, which had kept rates effectively at zero or below zero for nearly a decade through yield curve control, ran into a fundamental contradiction. Raise rates to fight inflation and the cost of servicing 263% of GDP in debt explodes, potentially breaking the domestic bond market. Keep rates near zero, and inflation erodes the real value of those bonds, a slow motion default by another name. When the Bank of Japan made even small adjustments to its yield curve control policy in 2022 and 2023, the yen dropped to its lowest level against the dollar in 32 years. The market interpreted even the smallest sign of normalization as the possible beginning of the end of the closed loop. If Japanese interest rates were to normalize to even 2%, a level that would still be considered emergency low in almost any other developed country, Japan's annual debt servicing cost would exceed its entire annual tax revenue. The government would be mathematically unable to pay its interest obligations without printing money. Japan has not collapsed, but Japan is the slow motion demonstration of what happens when the reckoning is postponed for so long, so consistently, that the reckoning itself becomes existential. The longer the delay, the larger the adjustment. That adjustment is no longer a question of if, it is a question of what triggers it. Country number one, the country nobody wants to name. Every economist who has looked honestly at this countdown methodology knows which country belongs at the top. The reluctance to say it out loud is itself a data point. The United States government now spends more on interest payments on its national debt than it spends on national defense. In fiscal year 2024, interest payments totaled $1.1 trillion. The defense budget was $886 billion. Interest exceeded defense. That specific threshold, interest costs rising above the defense budget, is the exact marker Ray Dalio identifies as stage 5 in his empire cycle analysis, the stage where the financial system becomes mathematically constrained rather than merely stressed. U.S. debt to GDP is 124% above Rogoff's 90% threshold. The Congressional Budget Office, using conservative assumptions for growth and interest rates, projects U.S. debt reaching 200% of GDP by 2047 if current trends continue. That is the Japanese path, the same sequence running on a longer timeline toward the same mathematical endpoint. The crucial difference between the United States and every other country on this countdown is the reserve currency status of the dollar. Because every country on earth holds dollars in central bank reserves, in international trade contracts, and in sovereign wealth funds, there is a built-in global demand for dollars and for dollar-denominated U.S. Treasury bonds that no other country can replicate. The privilege the United States still holds is that the world is willing, at least for now, to finance its imbalance. But that privilege is not permanent. It only works as long as global confidence in the dollar remains structurally intact. And that is where this becomes more serious than most people understand, because for the first time in decades, that confidence is no longer being questioned only by fringe analysts or ideological critics. It is being tested by behavior. Central banks around the world are buying gold at the fastest pace since the late 1960s. Countries are building alternative payment systems that reduce dependence on the dollar. Bilateral trade agreements are increasingly being settled in local currencies. None of this means the dollar collapses tomorrow, but it means the outer architecture of the system is beginning to shift. And once that process starts, it rarely reverses. It compounds. That is why the United States sits at number one. Not because it is about to become Zimbabwe, not because the dollar disappears overnight, but because the United States is approaching the same structural dead end point that every other country on this list has approached, while being protected by a reserve currency status that delays the reckoning and therefore makes the eventual adjustment larger, more destabilizing, and far more globally contagious. The reserve currency is not an escape from the debt cycle. It is a postponement mechanism. And the longer the postponement lasts, the greater the eventual imbalance becomes. This is the part most people miss. They look at sovereign debt crises as isolated events, separate stories in separate countries with separate political systems. But Dalio's entire framework argues the opposite. These are not isolated stories. They are recurring patterns. The names change, the flags change, the political rhetoric changes, the mathematics does not. Once a nation passes the threshold where debt servicing begins to crowd out productive investment, once reserve adequacy weakens, once monetary orthodoxy gives way to politically convenient currency debasement, the cycle becomes self-reinforcing. Growth slows, borrowing rises, confidence falls, capital leaves, the currency weakens, import costs rise, social tension increases, political leaders respond with policies that make the next phase worse, and the country moves one step closer to the endpoints. So now that we have counted down all seven, the question becomes which one actually breaks first. Bangladesh remains vulnerable, but its debt burden is still low enough that it may yet stabilize if reserve pressure eases and export earnings recover. Egypt is under severe strain, and if subsidy pressure, currency weakness, and external dependency intensify together, it could move up this list very quickly. Pakistan is already living on the edge of the triple coincidence, and without continuous external support, its margin for error is dangerously thin. Turkey has already demonstrated what political interference can do, but it is at least attempting orthodox repair. Argentina is permanently close to crisis, but paradoxically, that familiarity with collapse has made it more adaptable than most outsiders appreciate. Japan is the slowest burning risk on the list, but also one of the largest because its debt structure is stable until the moment the domestic loop breaks. And the United States is the global version of the same story, buffered by reserve currency privilege, but not exempt from arithmetic. If you are asking which country is most likely to experience the next visible sovereign rupture first, the answer is probably not the one with the highest debt. It is the one where all three warning signals begin aligning at the same time under political conditions too fragile to absorb the shock. That is why Pakistan and Egypt matter so much in the near term. They are not the biggest economies on this list, but they are among the most immediate pressure points. If you are asking which country represents the largest long-term systemic risk to the global financial order, the answer is the United States, because no other nation's adjustment would transmit through every bond market, every reserve portfolio, every banking system, and every major asset class on Earth at the same speed. And that is why this countdown matters, because the next global financial crisis is unlikely to begin with the kind of headline most people are trained to watch for. It may not begin with a Wall Street bank failure. It may not begin with a stock market crash. It may begin with a sovereign nation quietly reaching the point where interest costs, reserve weakness, and political denial collide all at once. And by the time markets recognize what that collision means, the repricing is already underway. The real lesson here is not to memorize the list, it is to understand the pattern. Watch debt servicing as a share of government revenue. Watch reserve coverage. Watch whether leaders begin attacking central bank independence or treating money printing as a solution rather than an admission of failure. Watch whether fiscal discipline is politically possible or politically impossible, because that is the sequence that matters. And once you recognize it, you stop thinking of sovereign collapse as a rare black swan. You start seeing it for what it usually is, a slow mathematical process that becomes an obvious crisis only in its final stage. That is the danger of where we are now. Too many countries are entering different phases of the same cycle at the same time. In earlier eras, one country could break while the rest of the system remained stable enough to contain it. But when multiple nations are dealing with the same debt pressures, the same currency vulnerability, the same political incentives, and the same external shocks, the system loses redundancy. It becomes more fragile as a whole. One rupture no longer stays local. It propagates. And that is what makes this moment different. Bangladesh, Egypt, Pakistan, Turkey, Argentina, Japan, and the United States are not 7 random stories. They are 7 signals. 7 versions of the same warning flashing at different speeds and different magnitudes across the global systems. Some are near the breaking points. Some are still being protected by structural advantages. But all of them are telling you the same thing. The age of easy sovereign debt is ending, and the countries that fail to adapt before the market forces adaptation on them will pay the highest price. So when mainstream financial media talks about resilience, soft landings, temporary inflation shocks, or isolated fiscal issues, remember what history says. Sovereign collapses almost never look obvious until the very end. Right until the final phase, there are always explanations, always reassurances, always reasons to believe this time is different. Then suddenly, it is not different at all. It is the same cycle arriving on schedule. That is why this countdown is not fear-mongering. It is pattern recognition. And once you understand the pattern, you understand something most investors, savers, and even policymakers still do not fully appreciate. The next crisis does not have to begin in the weakest country. It only has to begin in the country where the sequence becomes irreversible first.